Pradip Shah, Chairman at IndAsia Fund Advisors, joins us on the show right now. Pradip, good morning to you. Too many moving parts, from the market for the markets to take cues from. But just a simple question: how do you set yourself up for this kind of a market environment? Do you brace yourself, for the further decline in light of all the negative news that's floating around, or probably just sit on the cash that you have and use this as an opportunity?
So I think clearly the uncertainties are still not over. We anticipated many of these. We've talked on your show in the past on the global front as well as some of the macro issues. Now the election uncertainty is one of the biggest uncertainties that we face. If we can resolve part of this Iran sanctions issue by having barter deal, as has been reported, that would be wonderful. It would help control oil prices globally, and also, of course, help us in terms of our balance of payments and so on. What really brings to my mind this need for the government to be proactive on micro reforms, not the big ticket reform. They've done the GST and so on, but now on ease of doing business, ease of administration for every individual and business people. So for instance, so many small things that are hurting us. We talk of this current account deficit, and in the past it's our remittances that have helped us. But just look at one scenario. We have $126 billion of non-resident deposits. FCNR 24 billion, 90 billion of deposits under the non-resident external account, but only 14 billion from non-resident ordinary account. Why? Because we have a 30% TDS at source. Now it is the NRO route that brings remittances in a large measure. Make it easy for people to send money, earn a little higher interest, continue deducting tax, but not at 30%. Not everyone pays tax at 30%. There are marginal tax rates which are much lower for those people. And so they they fear that they will not get refunds. So they don't bring money. Advance the bringing of money into the country. Little measures that can be done in a big way. We had this FPI circular by SEBI, which fortunately got amended. Why did they have to bring it out in the first place? There are so many little things, well-meaning initiatives, I presume, from the government's bureaucrats, but they hurt markets. And that uncertainty remains unless the Prime Minister and the government demonstrate that they're on top of this. I think we will face uncertainty. So best at this time, this election uncertainty adds to the problem. A little more liquid rather than less, unless you see compelling buying opportunities in individual scripts. And there are some. In the B group, 32% correction from calendar year, beginning of this year. And certainly there are some very attractive opportunities that are visible, but they are not for mass markets, they are for individual, they are not for mass the fund managers. These are for individuals and for high net worth families.
Pradeep, while we will come and talk to you about the specific pockets where you find the interest building, does the broader market sell-off, the quantum of the sell-off, the propensity of the sell-off, and the duration of the sell-off in the broader markets, and the time period over which small caps have corrected bother you, and the quantum?
Yes, it does. You see, you had a 19 point something, 20% correction in small cap scripts in September alone. The NIFTY and everything is corrected dramatically in September. Clearly, the scale of correction has been too rapid. Too rapid means it's taken the markets by surprise, and it has its own consequences. And then we compound them with problems that are of our own making, such as these surprises in defaults, for instance, ILFS default and so on. And in the meantime, the insolvency and bankruptcy code processes are not moving as efficiently as we want, and yet more companies are being put into the IBC code. So this clearly the system is failing our citizens just now. I think less bureaucracy, less government intervention, less intervention in markets, more market orientation from bureaucrat side can ease this problem. At this time, this duration is likely to continue because we have this election uncertainty now. With 5 election results coming out in November, clearly we have to worry whether there will be some negative messages received by the markets, whether the present government will continue to receive the kind of mandate, or will continue to get will get the mandate that they got last time in its next central elections. Those are issues which necessarily must be factored in by any investor.
Mr. Shah, good morning. Neeraj here. What do you make of the recent tightening of sorts that's happened in the NBFC space, while SBI has come out and announced that they will purchase a higher quantum of paper and portfolio in order to inject, I mean, for their own good, but that injects some much needed liquidity in the system as well. Does that ease up the pressure, or do you reckon that the pain of liquidity crunch in the NBFC space and therefore subsequent growth could well continue for an indefinite period?
See, one of the negatives for the NBFCs was a statement made by a deputy governor that NBFCs would have to look more towards other sources of funds than banks. Now here there was a symbiotic relationship. Banks were not able to originate as efficiently loans in certain segments of, whether it's personal loans or microfinance or whatever. And so they found that it was convenient for them and efficient for them to lend through NBFCs. Now that system suddenly, if it gets shaken up or on the margin gets reduced, then clearly the lubricant, which is finance, for the economy to move will be affected, and therefore that will cause a grief for the markets as a whole. So we are seeing that the NBFC message has been received badly, that you have to raise money from other sources. The SBI message is saying that, look, yes, you are good at originating, we'll buy good loans from you. That's and I think there is no choice but for the public sector banks, which are garnering deposits because of the confidence that the government is behind those public sector banks in an unprecedented manner. And so they will have to deploy that money somewhere. They can't just put it in government securities. They'll have to deploy it in lending. And here is one opportunity to buy loans from NBFCs, or otherwise originate loans directly to individuals and consumers and so on themselves. Now that efficiency is not yet visible in the public sector, and the private sector just cannot supply the needs of the market totally. So we will see, I think, the public sector banks definitely lend in directly or indirectly to the NBFCs. I don't think it can be dramatically reduced.
So would you believe, okay, that's part one of the puzzle. Part two of the puzzle would be, in these relatively difficult times, even if the PSUs were to lend, we have to admit that these are relatively difficult times than what they've enjoyed in the preceding 2 years. So in these relatively difficult times, would the consumer financing companies which have a shorter duration on both sides fare better as opposed to the ones which are used to borrowing short and lending long, the likes of housing finance companies or infrastructure finance companies?
So not all housing finance companies were borrowing short and lending long. Yes, on the margin they all got tempted because the money markets were good and so on, and they all built up sizable amounts of borrowings from the short term. But otherwise, typically they were borrowing from the National Housing Bank or public sector banks and then lending out, and deposits had gone out of fashion anyway. So this correction is a healthy correction. You remember 2008 crisis in the United States. It came about because the money markets got frozen up, and this short-term lending and short-term borrowing to lend for long-term collapsed, and that caused the greatest grief in the US. And I think we've avoided that by bringing it to attention through through problems of the ILFS and so on. However, what we need to realize is there's still vulnerability. These money market funds, they have attracted huge amounts of money. They have been deploying also in a different way. Some of them are taking risks on a longer term basis when they should not be taking risks with liquid funds in longer term instruments. So that correction also, I think, it has been salutary just now. We've seen a drop of almost 10% in money market funds assets, as it were, liquid funds assets. And it is a recognition that people can pull out money quickly, because when they see that LIC mutual fund has 740 crores exposure to ILFS, certainly the other guys who are in the LIC mutual fund will say, let me pull out my money before the net asset value reflects that loss. And so they start pulling out. This is exactly what has happened. And I think there is both sides, on the lending side as well as on the borrowing side, recognition that borrowing short and lending long is not the right thing to do. It has to be more matched. I think it's a good salutary lesson. I hope we don't have any further crisis of this making. What we have had has been good for us, a good lesson for us.
Right. Pradip, just one last question before we let you go. Value buying, according to you, lies within which pockets? I mean, we've been seeing sectors like pharma, IT, gaining from tailwinds of the currency move, but in particular, something that you've got your eye out for.
So I think the pharma sector, the IT sector reflected what we were talking about earlier, that people realize that we are able to provide solutions to global companies and at a cost-effective price, and with the currency drop, then we are even more competitive. In the pharma sector, there are many Indian pharma companies that have that competitive advantage. They have the ability to produce reasonable quality. The attitudes have changed. They are very GMP conscious, and so they can possibly continue to be leaders in supplying generic products to world markets. And they're diversifying away from US markets. Now, China is a great opportunity for India. So, for instance, Dr. Reddys is addressing the Chinese market. Other companies have not yet cottoned on to that. I think we will see the pharma sector reflect this competitive advantage in the share price also. They've fallen dramatically because the sheen was off the US market for some time. I think come FY19, calendar year 19, CY19, we will see that again the US buying reflects the competitive advantage of Indian pharma companies. So pharma sector definitely is one. Some of the metal sectors got beaten up. I think just now the domestic economy demand is doing well. I hope the uncertainties of election and these interest rate rises and so on do not affect demand. If the demand continues like it is, and the minimum support price program, the NREGA program, all help in creating demand. So if demand continues, I think some of these scripts look very attractive to me.